Hey guys, welcome to today's live analysis session, or rather today we will be covering more on price action trading masterclass. Right, so for those of you guys who are here with us, a very warm welcome. So just wait for about 1 to 2 more minutes for more people to stream in before we get the session started. Okay, at the same time, if you guys have any questions, please do put them under the questions tab, right? So I have both the chat box as well as the Q&A box open. So if you guys have any questions, feel free to put them there. If there are any charts that you want us to take a look at as well, please put them under the questions chat. Okay, so I have both the chat box open, so we'll just give it about a few more seconds for more people to join us, and we will get the session started. Okay, so let's get the session started. Okay, so a very warm welcome, right? So I'm Lee Sing. This is an introduction of myself, right? I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the best FX research. You can find me on LinkedIn as well. So if you guys have any questions, especially when you're watching a recording of this, please feel free to reach out to me on LinkedIn. If not, right, if you're here with us live right now, do put your questions under the questions chat. So just a quick disclaimer before we get the session started. The information presented here is not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today. I will first cover the multi-time frame analysis, as well as how market structure comes in play. So essentially looking at how we can combine different market structures across different time frames and what we can derive from there. So that's the first part of the session. And following which I will be covering a little bit more on supply and demand zones. So for supply and demand zones, you can think of them like support resistance areas, right? So this will be areas where we will hop onto the chart and identify potential supply demand areas. And when price enters into these zones, this is when we will go down to the smaller time frame, essentially to try and find confirmation. So understand that as with support resistance concepts, right, we do see reactions of the supply demand areas, but these are also areas that can be broken. So with supply and demand areas, once we have covered this concept, we can also hop on to determine entry, stop losses, and take profit targets. So these are not trade recommendations, but rather they can just be concepts that you can explore when you are trying to come up with your trade strategies. And then finally, we will cover risk and trade management concepts, right? So for today's session specifically, I'll be focusing more on market structures and time frame analysis, as well as covering supply and demand areas. So if there's any specific examples that you want me to take a look at to apply these concepts, especially when we're coming towards the end of the session, right, please do put them under the questions chat. Okay, so first let's cover a bit more on market structure, right? So when you load any chart on TradingView, you can see that generally markets are split into 3 types. So we have one where it's an uptrend, one that's a downtrend, and the last one is when markets are moving sideways. So in an uptrend, in order to classify an uptrend, you want to see successive higher lows and higher highs being formed. So sometimes when you take a look at these structures, especially on TradingView, right, if you load any chart, you don't see such clear structures that are being formed. So in this example, right, you can see that this is very clear structure where you see clear higher lows and higher highs that are being formed. But in this case, right, of course, this is in theory. When you load an actual chart, most of the times when, depending on the time frame that you're on, you can see that the structure might not be as clear. So how you can use this to help you, it's that when you're loading a chart in general, on let's say TradingView or any other platform for that matter, right, just go shrink the chart, right? And you can see that you can identify the overall move in the market. So what I usually do at the start, especially when you're not familiar with market structure, is to take a glance at a chart, just mark out the lows and highs. So let's say, for example, this is an example of a chart that's taken from TradingView. Just highlight the highs, highlight the lows, right? So these are extreme turning points that we see here. And ideally, when you highlight these zones, you want to ensure that these areas have significant movements. So what I mean by this is that when price comes into this zone, we want to make sure that coming into this area, we have a sharp reversal of this point rather than just a small, tiny one if it continues to the downside. For me itself, this area, this move over here, would not be classified as a significant move. So you want to see as much as possible very clear zigzag patterns that are being formed. And when the zigzag patterns form consecutive higher highs and higher lows, it tells you that the market, at least on this time frame, is in an uptrend. The reason why it's important to identify this, it's because of the assumption that the trend should continue, right? So if you're in an uptrend, the assumption is that any pullback in price itself, when price comes into a support area, it should continue to form higher lows and higher highs. So that's the assumption that comes with it. What's also important to note is that when you're in an uptrend, the highs themselves are constantly areas that you can target, especially when you're taking long positions for take profit. The idea behind this is that this high itself, right? So in an uptrend, you can see that the highs are constantly being violated and the lows are the ones that are constantly holding. So generally in an uptrend, right, you want to make sure that your stop loss, if you're taking a longer term trade, you want to ensure that your stop loss, it's below this structure, because if the uptrend is to continue, price should not be breaking below this structure. If price breaks below this structure, it signals a potential change in trend, right? Because this is the last low that you see that caused the break in structure. It's the last low that broke the high. So if price breaks below the structure, it signals a potential change in trend. So this concept, it's easy, but it's extremely important in helping us to identify these moves, right? So if you're trying to find entries on a smaller time frame, understanding these concepts and how it applies, it's useful in helping us to determine our potential setups. So this is for an uptrend, right? So I hope that this is clear. Let's move on to the downtrend right now. So in a downtrend, it's the other way, right? So you want to see successive lower lows and lower highs being formed. That's one. And as you can see here in a downtrend, the lows themselves are constantly being violated. So what I mean by this is that if you're taking short positions, you can target these lows as your take profit targets. Whereas the highs in this case, you can see here, these highs themselves are constantly holding, you can see, right? So there isn't a case where price comes over here. If the downtrend is to continue, we shouldn't be seeing a case where price comes into this area and break above it. So this it's usually rare, especially when you're on the higher time frame. Of course, if you're on the smaller time frame, right, smaller time frames would hold less weight because it's the fractal nature of market itself, right? It essentially just means that any moves on the smaller time frame is just a part of the bigger time frames moves. So if you're in a downtrend, for example, this area where you see successive lower lows and lower highs, what this suggests, right? So on the smaller time frame, you can see this pullback within this area. But what this suggests is that this successive higher lows and higher highs that are being formed on the smaller time frame, it's just part of this whole pullback move that we have before price continue to the downside. So this is one way you can think of it, right? So in a downtrend, we want to see that these lows are constantly being targeted. So these lows can be potential take profit targets, and this high should not be violated. If prices break above this structure, there's a case where there's a change in trend. So this is when we want to get out of the position. So the stop loss should be placed in an area where if you're wrong on this trade, you want to get out of the trade. Right, so this is an example. You can see that again, if you were to just load any chart, what you can do for a start, especially when you're just taking a look at market structure for a start, just mark out the highs, mark out the lows, and you can see that in a downtrend, right, these lows are constantly violated. So then it comes in the concept of support and resistance levels as well. So the idea behind this is that when price comes in as a support area, so price held as a support area here, what happens is that the first time, right, it might not induce as many buyers, especially when we see a sharp movement up. The second time price comes into this area itself, you can see that we have two cases, right? So buyers would tend to enter the market, people who missed the first move here. The second one is that when you have people who are taking short positions here, what happens is that they will sell all the way, right? So when they sell here and price reaches into this area, they will either, number one, aggressively protect their position, or the second one is to take partial profits. So when they take partial profits, this is when it pushes prices higher. Okay, so when price comes into these zones, what's important to note is that when we see a failure of this area, right? So it induces buyers to come in here and then again over here. But you can see that in this case, when there's a sharp bearish move against it, what this shows you is that there is a lack of buyers coming into the market and you see strong selling pressure. At times like this, right, imagine the buyers who entered the position earlier on. So imagine people who held onto the buying positions here, who entered the buying positions over here, and then again long positions over here. So when price breaks below, and assuming that they don't have their stop loss triggered yet, what happens is that they'll be in a negative position. So when price comes back into this area, they could, for one, close out the position. Right, so that's more on the psychological side of things. So if they close out the positions at break even, this is when it triggers sells, right, for price to continue to the downside. So in terms of how this turn becomes a support turn resistance level, you can see here, right? So when it induces buyers in and it fails this level, especially marked by a strong bearish break. So imagine a bearish candle with a huge body, right, breaking through. This usually signifies strong selling pressure. So when price comes back into this area, buyers who are holding onto the position would want to close out, right? And people who are trading just based on support resistance concepts might want to enter at a resistance zone. So these are just some things to take note of, right? So in terms of looking at market structure, one thing that ties in closely with market structure is, of course, the concept of support resistance areas, right? So another way you can take a look at them would be supply demand zones. So this is for downtrends, right? Let's take a look at the sideways trends. So for sideways trends, it's the way, right? So how you can identify this? Usually, in this case, you can see that there is no clear highs and lows. So if you mark out a chart, usually the highs and the lows would be at equal level. So you can essentially draw a horizontal line that connects them. So in this case, what this shows us is that prices are trading within a range and there is no clear trend. So there isn't a clear uptrend where there's consecutive higher highs and higher lows being formed. There isn't a clear downtrend as well. So in this case, you can see here, prices are within a range. This is the theoretical part of it where you can see how price react on the highs and the lows. And this is an example that's taken from the chart. What is interesting about this is that there are a few things I want to cover here, right? So one is on liquidity sweep. So the idea is that when prices are in a range, right, especially in this clear range where you see extremely clear support resistance levels, understand that when price comes into these zones, right, so which is why it's not advisable to take a trade immediately off these highs, because when price comes into this area, right, notice this spike over here. So let me just remove all this marking so that we get a clear one. So notice this spike here. So essentially what happens is that when price comes into this zone, we saw a significant reversal of it and price pushed higher into this area and coming into this resistance area again. You can see that over here, right, essentially it induces sellers, right? So people who miss this first position, they will sell over here. And once you have a sell, right, so you open a sell order, what happens is that they will have their stop losses lying just slightly above this area. So imagine the stop losses just lying slightly above these zones. So when this happens, right, these are basically areas of liquidity. So imagine an area where there are huge amounts of order that are lying there. And it's important, right, especially as a big player, if you want to enter the market, you want to tap into these areas of liquidity, these areas where you have a lot of sellers or buyers in this case, right? So if they're getting someone to take the opposite direction, they are essentially waiting for buyers. So you want buyers who are willing to take your price, and you want to have a case where you have many buyers at a certain price that are willing to take this price. Because if you're going to sell, you want to have basically the party take the opposite direction, right? So if you are going to sell, you need to find someone to buy. So essentially, when you tap into these areas of liquidity where you have huge amount of buyers lying there, this can be in form of stop losses for people who are taking the short positions, or it can be in the form of breakout trades. So people who are waiting for a break above it, right, or would not want to wait for a break and close, and they're just taking the immediate trade up on the assumption that price would continue much higher. So in this case, right, when there are areas of liquidity lying here, what happens is that if you're looking to sell, right, price would spike slightly higher, tap into these areas of liquidity, as you can see here. So it'll be represented by this wicks to sweep this movement, right, and also sweep stop losses that are lying slightly above it. But the idea is really just tapping into areas where institutions or bigger players can get huge orders in without moving price too much. So that's the concept. So when price comes into this zone, you can see that this sweep that we call, right, it can be induced liquidity sweeps, essentially sweeping areas with high liquidity, right, or huge orders lying there. So in this case, right, if you do see a setup like that, what would be a better way to do it is to basically wait for the setup to enter into this zone, so the support resistance zones that we've identified, wait for price to enter into this area. Once price enters into this area, you can go down to the smaller time frame for confirmation, right? Instead of taking an immediate trade of this area. The reason it's not advisable to do that, it's because if you take an immediate trade of this area, right, for one, you might have no place to put the stop losses because there's no gauge of how far you want to put it. That's one. And the second one is that there's the case where price could break way above this area and continue to the upside. So which is why, as much as possible, we want to try and find a reversal on the smaller time frame to first confirm that this zone is indeed holding. Okay, so that's the first thing with regards to sideways market. The second thing about sideways market is that when prices are moving sideways, right? So this has to do with the concept of strong highs as well as strong lows, weak highs and weak lows. So we will be taking the concept from downtrend and uptrend. So the idea is that in a downtrend, we see, as we've mentioned just now, right, the highs would hold and the lows would be constantly violated. In an uptrend, it's the other way around. The highs are constantly being violated and the lows would hold. So this assumption goes in a way that when the low itself caused the break in structure and took out the high, we are assuming that this low itself is a strong low and it should not be violated. Now apply this concept to what we have over here in the sideways market, right? So this is slightly different. So imagine prices are moving in this zigzag format, right? So essentially, when price comes into a resistance area that we have over here, right? So let's say price comes into a resistance zone here. And on the smaller time frame, we are seeing confirmation of a bearish reversal. So this can be a change in structure on the smaller time frame, break of the last low before it continues to the downside. When you have a reversal like this, what this shows you is that this low itself failed to break the high of this, right? So this low itself is a potential target. Okay, so that's one way you can think of it. And it's extremely useful when you apply these concepts, especially because you have this smaller time frame confirmation. So again, right, I want to emphasize, when you're in a sideways market, you can actually borrow the concept of highs and lows that we see in the trending market. And once price comes into a resistance area here, right, if we are seeing confirmation of reversal on the smaller time frame, it's extremely important that you wait for confirmation on the smaller time frame. Once this happens, you can see that when there is a reversal, usually what this shows us is that this low itself fails to take out the high and it can be a potential target for your take profit. Okay, so I hope that this is clear so far, right? So with that, let's hop on to the chart, right? So before we go on to the summary, I just want to show a few chart examples on what we can see here. So let's take a look at this example on dollar yen, right? So as always, you want to start from the higher time frame. So before I hop onto the chart and do the analysis, right, I want to cover, since today is more on covering market structures and supply demand areas, I'm going to be spending the next few minutes just covering what supply and demand areas are and how you can identify them. So there are a few ways you can identify them, especially on the higher time frame, right? So let's say take a look at the weekly time frame. One way to do it will be based on structure. So what I mean by this is that take note of how prices are moving. So in this case, right, you can see here in this movement, if I have to trace out this move, essentially you can see price pushed up higher. We see this reversal and then again over here. So this is one way to trace it. Another way is to take a look at the line chart and just highlight significant reversal. So if I were to trace this move, you can see that this is essentially how it looks like. And this structure itself, you can see that this low took out the last high. It caused the break in structure. So recall in an uptrend, this low should not be violated. So what this shows us over here on the weekly picture is that currently prices are sitting on a support level. And how do we know that it's a support level? It's because if you take a look at the structure, you can see that this movement itself, the low broke the high. So this low pushed and break above the high. So as long as price holds above this structure, this zone over here, this area that caused the break in structure, the extreme of this move can serve as a demand. Okay, so this is how you can identify potential areas of demand. So understand that we're on the bigger time frame, right? So on the higher time frame, on the weekly, if prices are sitting on the demand area, it doesn't mean that it will definitely go up. But rather what this shows is that if we are seeing reversal on the smaller time frame, right? So let's say if I'm on the 1 hour time frame and I'm seeing, or maybe 4 hours, in this case will be clearer. So on the 4 hours, you can see that in terms of structure, there are still lower lows and lower highs being formed in terms of a break in structure here. So again, right, is there confirmation of a reversal as of now? Not yet, right? So what we want to see ideally is a new structure being formed. For example, right, this new low that's being formed, a pullback into a demand area. So into a demand area here. And once demand starts gaining control, what this shows you is that this high itself fails to take out the low, and this high, it's a weak target. We could be seeing more upside. and this would be in line with the bullish order flow on the monthly time frame. So that's the thought process behind this, right? So currently, as of where we are right now, you can see that this is the last structure. Price broke the structure. So any pullback within this leg, right, we could be seeing a new high that's being formed. But right now, we need to wait for structure to be formed here. So this is the example of how you can apply these concepts on dollar yen, right? So back to the weekly time frame, right? So I was talking about supply demand areas. So one way to identify them would be taking extreme of these moves, essentially the moves that caused the break in the previous structure. So if you see higher lows and higher highs being formed, then demand area comes in on the extreme of this candle. So this would be one demand area on the weekly time frame. Another way you can identify demand area. So in this case, right, this will be the first demand area. The next demand area comes in over here. So you can see again, this is the extreme of this move, this candle here. So you saw how price broke above this area. And this is the last move that causes the push up. So this is the next area that we have over here. So these are the two demand areas. On the weekly time frame, usually I'll just highlight two or even one demand area, right? Given that price will take a while, right? It's currently in this zone right now. So in terms of the supply region, right, there are a few ways you can identify them. One would be based on support resistance levels. So for this, right, what you can do is look for interactions within this area. So for example, this area over here, right, if I were to extend it across, you can see how price interacted with this zone. So see how price rejected over here, tested this region, and it broke above this region. You can see here, retested as a support, continued higher, and coming into this region, you can see that it wicked below it, retested as a resistance before it continued to the downside. So this is one area to watch. Another way you can identify this is just taking a look at it in close. So if you take a look at it in close, just draw a horizontal level across, you can see that an area where it segregates the price nicely here, as well as this area, right? So these are potential support resistance areas you can consider as well. So this would be the two zones that I will consider on the weekly time frame. And you can see the pullback here, right? So if you're on the daily time frame, you can see that currently prices are still in a bearish move, and you can see it clearly here. So one interesting thing to note is that how you can combine market structures across different time frame, and you see this example very clearly. You can see that we're still in an uptrend on the weekly time frame. How so? Because this low itself that took out the high is still not violated. So in terms of structure, this is the last range that we have. So until price breaks below this low on the weekly, right, this low that we have over here, currently the structure on the weekly is still bullish. So this is on the weekly. We are seeing a pullback right now. So in terms of retracement, so if I were to just mark out the weekly time frame, you can see that this is the push up and this is the retracement. But notice that the retracement on the daily time frame, right? So if I go to the daily time frame, you can see that this retracement that we have, which is this move down, which supposedly should form a bullish leg, a bigger part of it's just a pullback within the weekly zone. But if you are on the daily time frame, you can see that in this case, it's forming bearish market structure with lower lows and lower highs being formed. So what this shows us is that if we were to see any reversal and continuation of the uptrend on the daily, we need to first see a change in structure. So you can notice how this market structure across different time frame tells you different stories and what you can interpret from there. So this is on the daily time frame. You can see, so in the daily, it's still holding bearish market structure and it broke structure. So anywhere within this leg itself on the daily time frame, it's still bearish. So that's one, right? And then if you go on to the 4 hours time frame, you can see again, right? So this is the pullback of this whole leg. So on the 4 hours, this is bearish and this is the range, the last range that we're looking at. You can see that this high itself broke the structure. So anywhere within this leg, right? If prices pull back into a supply area, we're expecting more downside. It might not break this low, but it might not break this low because we are on the higher time frame support region. But the idea is that when price comes into this area, again, we want to wait for confirmation, entering into demand area, confirmation for more upside with the smaller time frame. But what I want to highlight over here that's important or rather interesting to note with market structures is that you can see the break in structure. That's one. The pullback, right? So notice this pullback on the smaller time frame. So this is on the 4 hours. You see just a move up here. But if you have to go on to the 1 hour time frame, you can see again higher lows and higher highs that are being formed. Successive higher lows and higher highs that are being formed. And this higher lows and higher highs, it's just a pullback leg within the H4. Okay, so this is how you can wait for confirmation, which is why I've emphasized it again and again. If you want to take any reversal, you need to wait for confirmation on a smaller time frame. So using this example that we have over here, right? So on the 4 hours, you know that we have this range. This is the high and this is the low. Anywhere within this leg on the pullback, we could see more downside. That's one. And within the H1, so on the assumption that we could see more downside on the 4 hours, right? The confirmation on the H1 comes in here. So this is the pullback leg. You can see that currently on the H1, it's still forming successive higher lows and higher highs. So what this tells you is that even if price enters into a supply zone, let's say on a 4 hours time frame, does it mean that we're taking an immediate short? We're not, right? Because we are not assuming, we're not trading based on assumptions, but rather we're trading based on what the market tells us. We might be wrong, right? But that's just part and parcel of it. So when price comes into this area, right? So essentially what we're trying to look out for is that coming into this region, you will see again, bullish move up. So successive higher lows and higher highs that are being formed. But when there is confirmation that this is indeed the resistance, or we do see a reversal, you will see that on the smaller time frame. So in this case, it can be the 1 hour, the 30 minutes, the 15 minutes, you essentially see reversal here. So a break below the last structure. And once there is a change in structure, so recall that in an uptrend, the low should not be violated, right? So once price breaks below this low, it tells you that there is a chance that this higher time frame's resistance, which is this zone over here, it's holding, given that there is a change in structure on the smaller time frame, which shows us that this uptrend, which is essentially the pullback leg, so this uptrend over here, which forms the pullback leg, it's indeed showing the reversal. Okay, so I hope that that helps in identifying the different market structure and how you can possibly take a look at market structure on the smaller time frame for confirmation. And so this is extremely useful. You might not get it right all the time, but once you do get it right, you can see that it can be very useful in helping to time this movements. And when you have a smaller time frame confirmation, right? So the idea behind this, right? So now I'll cover a little bit more on entry, stop losses, and take profit targets. So assuming that we have this move over here, so let me just remove this area. Right, so let me just remove all that, right? So assuming that we have a support area, so let's use this demand area as an example. So let's say this demand area over here, right? So one way you can identify support resistance area. So let's say this is zone. So this is an area, you can see significant movement here, right? Seeing how price rejected as the resistance, broke above, tested as a support, retested, and then a pullback within this area. So this is one demand area here. And also, if you take a look at it in line chart, you can see, right, if I were to draw a horizontal line across that divides it nicely across, you can see this is an area where price came in to test it as a resistance and support here, and then again over here. So this is one. So when price comes into this region, this is the support area. You can see this area here. Oops. So when price comes into this area, right? So we wouldn't know for sure if this demand is going to hold, right? Because there's always a chance that price could come deeper. It could mitigate this area, this demand region. It could come into the extreme of this zone. So when price comes into this region, the idea is that if we do see a reversal, right? We are seeing a downtrend here, right? So we should be seeing a reversal first on the smaller time frame. So let's focus on this region, right? So go down to the smaller time frame here. So let's say if you go on to the 15 minutes time frame. Okay, so right now here, we don't really get to see much of a market structure. You can see that there are no clear lows and highs that are being formed coming into this region. So nothing much here, right? But if you go down to the smaller time frame, let's say the 5 minutes. So you can see here, right? So in this example, you see the structure started forming here. So on a 5 minutes time frame, if I were to draw the highs and lows, right? So same thing, mark out the highs and lows. You can see this move. So this is the high, this is the low. And then a new high is being formed, which is this region here. You can see here. So this strong push up and price came in and it came into a demand area, but we wouldn't know whether this is the demand area, right? Because this is on hindsight. So of course I can say it now because I saw how price react. But the idea behind this is that price comes into the extreme of this region. But what's important to note is that the first sign of the reversal comes when there's a structure being formed. You can see here, right? So strong push down into this demand area we have on the higher time frame, this reversal, and a new structure in form of new high is being formed. So this is the new high. Let me just remove all these drawings and mark out this high. This is the new high. This is the structure that's being formed. So the assumption is that if this demand area doesn't hold, right? So if this gray zone that we have on the bigger on the 1 hour picture doesn't hold, price should continue to form lower lows and lower highs, right? Because it's going on a downtrend on the 5 minutes time frame. So if it holds, then you can see that this high itself should fail to take out this low. So when the high failed to take out this low, this is the first confirmation that this demand area is going to hold. And how we can tell from this, right? So this is the high, this is the last 5 minutes high that's being formed. So you can see here, you can draw it in terms of line chart, right? So this is the last significant high. Again, you see this huge movement, right? So here, so this is the last, this is the last high that's being formed. You can take a look at it in line chart, take a look at it in candlestick chart, right? But the idea is that once there's a break and close above this region, so in this example itself, right? If you want to be more conservative, it's better to take a look at it and take a look at the high. So wait for a break above this high here. a break and close above this high. So the idea behind this is, well, this is based on individual preference, but because I want to make sure that it is a confirmation and not a fake out, which is why I will take it on this break instead of this close. Okay, but this is depending on your preference. So when price breaks above this high, which you can see represented by this bullish candle here, the strong bullish candle, you see that this is the confirmation that this high indeed has failed. Price broke and closed above it. And what's more important is that this is in line with the higher time frames order flow. It's in line with the 1 hour. It's basically this 5 minutes is telling us that the 1 hour time frame, the support region is going to hold because of this break in structure on the 5 minutes, which is a sign that this trend might be changing. Because on the 5 minutes, right, coming into this zone, you're seeing bearish market structure in terms of lower lows and lower highs that are being formed. If you have to mark out the highs and lows, you can see these are the highs and these are the lows. Okay, so once there's a break above the structure, you can see the confirmation comes in over here. Then what happens afterwards is that in terms of supply and demand area, the break in structure, right? So this is the demand area, you can see, right? So this will come in terms of resistance turn support level. So essentially seeing a resistance, price breaking above it, retesting as a support. This can also come in form of breakout strategies, where there's a break and close above, wait for a retest and continuation to the upside. So you can see that the confirmation really comes in over here on the break and close above this high. So this area, essentially. And then price retested this region again, the support area that we have, continued to the upside. So this is one way you can consider, right? So one way you can take your entries, it's to take it off demand zones or take it off support resistance areas. So once there's confirmation of this, right, essentially it helps to confirm that there's a higher chance that this demand would hold, and also there's bullish order flow. So the smaller time frame is aligned with the 1 hour picture. We can take a long, right? Now, where will we take a long until? So recall that we derived this zone from the 1 hour time frame. So I'll go back to the 1 hour time frame. So this is where we use the concept of lower lows, strong lows and highs. So on the 1 hour time frame, right, this is where we will, right, where we identified this 1 hour, recall, this demand zone. So this was the high that pushed price into this demand area. So if on the 1 hour picture, it shows that demand areas start holding, right, and we're seeing bullish order flow, what this tells you is that this high itself, right, so recall in an uptrend, highs are constantly weak and they are constant targets. So this high itself is a weak high and it can be a potential target for your take profit. So this is where you can take the high, right? So of course, price could continue much higher. You can see in this example, price actually pulled back and continued much higher. But what this shows us is that when this high fails to take out the low, right? It fails to form a new low and it comes into a support area. And more importantly, on the smaller time frame, you're seeing that the support region is starting to hold with a change in structure on the 5 minutes. What this shows you is that this high is a potential target, right? So if you take long positions, you can target this high. So you can see what happens, right? So essentially price pushed up higher. And then of course, we see a retracement for much bigger move up. But the idea behind this is that if you want to take it, especially take trades on a smaller time frame, you need to ensure that when price comes into a key support resistance area on the bigger time frame, right, you are either taking partials or protecting the positions. Okay, so this is an example of how you can basically combine market structures based on different time frames, understanding order flow, right? Helping you to take a look at the market structures across different time frames to determine the order flow, and also how you can use these market structures as profits as well as entries and even confirmations. So it's all based on market structure. You can see here, right? So in this example where we identified the support zone, what you want to do in ensuring the support on the H1 is going to hold is to first wait for a change in structure first on the smaller time frame. Okay, so I hope that helps in terms of clarifying or even just helping in terms of seeing how you can use market structures to determine where prices might potentially be heading, and also using the smaller time frame or just combining different time frames to determine the potential direction. Okay, so yeah, if you guys have any questions, please do put them under the questions chat. Right, so for today, basically we covered our market structure and covering and also how we can apply them across different time frames. We talk about 3 different types of market structure. So basically uptrends, downtrends, as well as sideways. I also covered the concepts of strong lows as well as weak highs and lows, right? So essentially how you can use this direction and how you can use this market structure in determining where prices might be heading. And you can see that how these concepts are being combined, right? It's basically just market structure and layering them across different time frames. And when you have confirmation on a smaller time frame, essentially this shows that the higher time frame support or resistance zones would hold. So that's one. We also covered on supply demand zones, right? So in this example, I covered more on demand areas. So essentially ways we can determine demand zones. In this specific session, we covered on how we can use extremes of these moves, essentially extremes of moves that can cause the break in structure to determine the demand area. So if this low itself caused the break of the previous high, then when price comes into the extreme of this region, this is a potential demand area, but we're not taking immediate long positions from here because you can see that coming into this zone, right, you will see lower lows and lower highs that are being formed. So in order to confirm that this low itself, or rather this demand zone is going to hold, we need to wait for a change in trend on the smaller time frame first. So this can come in the form of a change or break in structure, a break of the last high for continuation to the upside. We saw this example on dollar yen on the 5 minutes time frame, right? So essentially seeing how we can combine the 1 hour time frame as well as the 5 minutes time frame. We talk about specific zones, right? Extreme of this zone. So these zones that cause the break in structure can be demand areas. So I haven't really covered much on the trade and risk management, but the idea behind this is that when you do determine the order flow, right, even though this, you might be very confident about the setup, don't risk more than 2% on any of the positions. So it's important, right? So let the risk to reward play out in your favor. If you're wrong, be sure to take the stop loss levels, right? So usually if you are taking the extreme of these moves, near these lows, right? So if you have demand areas that are near a previous structure, a previous low, right? You can just put the stop losses slightly below these areas. So when price comes into this zone, right? If there's confirmation on the smaller time frame and it shows that this demand area is holding, we should not be expecting this demand area to break, right? So the confirmation on the smaller time frame, once there is that confirmation, so maybe let me just go back to the dollar yen example. You can see that on the dollar yen example, this is the 1 hour picture, right? So let me just remove all these markings. So this is the 1 hour demand area. Let me just remove this. Oh, I just made it messier. Oh well. Okay, but let's say here. So this is the demand area that we have, right? So if price comes into a demand area and on the 5 minutes, you're seeing that confirmation, which is really here. Right, so on the 5 minutes, if you're seeing that confirmation in terms of the change in structure, which is this area, right? The break of this line here. So what happens is that when there's a break of the structure, you can take long positions, right, based on support resistance areas and keep your stop losses just slightly below this H1 demand area. So the idea is that when there's a confirmation on a smaller time frame, price should not be breaking below this H1 demand area, which is this area here. So this is the H1 demand area, right? So when there's confirmation, price should not be breaking below this zone if you have confirmation on a smaller time frame of a bullish move up or a change in trend on a smaller time frame. So you can just put your stop loss slightly below these areas upon that confirmation. Okay, so this is on understanding, so on risk management, right? So position sizing and also understanding risk to reward concept. So the idea is that if you have a 1:3 risk to reward ratio, every dollar that you risk, when it hits your take profit, you get $3, right? So if you have a high risk to reward ratio, then you don't have to be right more than 50% of the time and you can still be profitable. And then we talk about using how we can use different time frames for confirmation. So in this example on dollar yen, we saw how we can use the 5 minutes time frame for confirmation. And also taking partial profits on higher time frame key levels. So I use the same example on dollar yen, right? Understanding the concept of higher lows and higher highs in an uptrend. These highs are constantly violated and they can be useful as take profit targets. So the idea is that when we do see a pullback into a demand area, go to the smaller time frame for confirmation once there's a change in structure, because the pullback in this zone, right, if you're on the smaller time frame, it will show your bearish market structure. Once there is a change in that, right, it shows that this demand area is indeed holding on the higher time frame. For more upside, you can put your entry anywhere, right, on this smaller time frame demand areas and stop losses below the higher time frame zone and target the high, right, because this high on the higher time frame is a weak high. If demand area starts holding, it shows that the high failed to take out any low and it's a potential target. Okay, so I hope that this is clear. Okay, so I think with that, we have come to the end of the session, right? So if you guys want to watch a recording of this, we do have it on YouTube. So just go to vantagemarkets.com/webinars, right? You will be able to see the YouTube videos. And if you guys have any questions as well, regarding account opening, right? Do email to support@vantagemarkets.com. Right, so I think we have no questions for today, right? So I hope that this session has been helpful. And yeah, with that, we have come to the end of the session. So for tomorrow, okay, Doris, if you have any questions, right, you don't have to raise your hands. You can just type it under the questions chat. Okay, so I'll just leave it about 1 more minute there. If you have any questions, do put them under the questions chat. In the meantime, right, let me just bring up the webinars. Right, so for those of you guys who want to take a look at the schedule, just go to Education and Tools, Education Webinars. So educational webinars, you should be able to see this, right? So this area, so you can see that there is the YouTube recordings over here. You can also take a look at the different sessions that are covered, right? So for tomorrow, we will be covering on volume analysis. So take a look at all this. Yeah, you can take a look at the schedule and the topics that are being covered. Okay, so I see that we don't have any questions. So no questions thus far. Right, okay, so if we have no questions, right, then I think that's all that we have for today. Right, so thanks everyone for staying with us throughout the session. So as always, if you guys have any questions, if you're watching a recording, feel free to reach out to me on LinkedIn if you're with us, right? I see that we have no questions today. So yeah, so that's all for today, right? So we'll catch you guys again tomorrow. Thanks everyone. Stay safe, trade safe, and we'll catch you again tomorrow.